Yeah, thanks a lot. That's funny because it's probably true that she's on the line here. But yeah, thanks for your time. I'm excited to talk about the story. Just sort of three fun facts that occurred to me over the last couple of days. I believe we're the only African-focused stock here, so I thought I had a niche story to begin with, but I think that's added to that, and I recognise that for some here that's a level of jurisdictional risk for you, but I would argue we don't have any expiration risk, and I'll tell you why. But I'll also argue that you're well compensated at our current price, and I'm also going to hopefully convince you by the end of this 15 minutes or so that I have here that we're the cheapest gold stock here, and I can make that claim, and I'll show you why, because we don't have to find any more ounces. We've got all the ounces here. We've got a permitted DFS project, and new management and new board. We were listed late last year. We inherited $110 million of invested capital into this asset already. So we've got a wonderful head start, and I'll show you how we're going to create some value here. So on balance, I would just argue that consider the story on balance for your portfolio. So who we are, Toubani, we think we are the next West African gold mine. The main project is called Kabada. It's compelling for these reasons. It's oxide dominant, so of our 3.1 million ounces, 1.6 is oxide. I'll talk you through that. That is free milling, free digging material, no drill and blast. We've got the scale here, like I said, 3.1 million ounces already discovered. And we can do 100,000 ounces a year for 10 years as our base case. That was the previous study. New management, new board think we can do something bigger and better than that, which makes us even more attractive in the sector. We're a permitted project, so once we get our ducks in a row here, the timeline to production is closer than others. And we're really focused on margin. For us, I was at Perseus before this, and if you look at Perseus, you look at West African resources, what makes those guys tick is low-cost assets generating lots of cash. And that's what we're focused on here. And because of that oxide rock, we can do this. We're underexplored. I'll talk to you about a discovery we made a few months ago. So even though this has had 150,000 metres drilled, 110 million bucks of capital invested, we're still making discoveries. This is a camp district play. And to underpin that story is the valuation I'm talking about. Toubani today trades at $3 an ounce. I don't think this sector, this junior development space in West Africa has ever been cheaper, but $3 an ounce for something that can be a mine tomorrow is pretty attractive, and I think that means we've got a low downside but lots of upside here, and so you can see where that takes you against peers and the M&A activity in West Africa. So yes, we're in Mali, southern Mali, where all the big elephants are. We're south of Bamako. Mali is, in some respects, is two tiers. The north there is where you see all the noise in the world, but we're in the south where we're the engine room of the Malian economy, and we're down there. We have no troubles. Again, like I said, we're permitted. The wheels of government still turn for us. We get our permits in place. Our reports are done. We have a really favourable tax regime there, so you get a tax holiday there for 3 years. The only royalty we have on this is the government royalty of 3%. So for our perspective, we're pretty encouraged where we are. And just to underpin that West African story, there is a suite of capital and activity in West Africa. These are the recent mine builds over there from big reputable companies that get things done, I would argue, quicker to find and develop an asset in West Africa than it is probably to do that in Australia. And then to the right, it's just the last 2 years of M&A activity in West Africa. So, there is a suite of capital there, and if you have the right asset. Quickly on the overview, like I said, listed last year, 100 million shares out. I would just say that we're really, for an asset, for a company of this size, we got some really good backers. So Nero Resource Fund there's at 17%, Ausbil, big Australian fund, 4%, and then Perennial just went substantial and asked a couple of weeks ago, they got 7%. So we're strengthening this register with the big institutions in Australia and globally, and that speaks to the vision that we have for the asset. That's why they're there. And I'll also tell you that on those options and warrants you see there, they're all priced at around 26 cents to $1, and our share price is 16 cents today. certainly management and the board, we're not really going to make any money here until the stock doubles from today. So we've got some skin in the game. We've been buying stock at this level because we believe in the asset here. So since joining in January, this is what we've done. We've been doing what we say, oxide dominant strategy. We bolstered the technical team. We killed our TSX fee listings. We only have one listing now in Australia. We've made new discoveries and we strengthened the board. We really have a bit of a rock star board going on here. I'll talk to you about that. And the last piece that I promised the market is we're reviewing that study, that 100,000 ounce a year study, for something bigger and better. And we'll have some commentary out on that in the next few weeks. This is the board and the management team. Some familiar faces, I think, for some of you guys. Mark Stryzek there was ex-Tietto. I think people will remember Tietto, small market cap to 800 mil market cap, West African gold producer. And I think he sees being able to replicate that here at Toubani. Scott Perry there is a ex-World Gold Council, major gold producer CEO. Danny's Glencore. Tim Kessel's a renowned deal maker. So we've got the right people in place to unlock this asset and make money for investors. This is the prize. Like I said, 3.1 million ounces in one big pit. What's unique here is the soft rock goes down beyond 70 metres, 70 to 100 metres for 5 kilometres long. That's free dig material, no drill and blast, shoots through your mill, 100 metres deep. That's really unique. Other West African projects, you're looking at around 40 metres. We've got a low strip ratio there. So when you see that grade, and I'll talk to you about that in a second, not all grade is equal, and I'll explain why we think that. Again, because this asset's been had a history, it's important to remind people that it's underpinned by some impressive results there. If you go through that 5 kilometres there, you see some ripper results that if we started to release those today, would be $100 million, but we're 15 mil. But you see things like 60 metres at 3 grams, 56 metres at 2.8, like they're peppered throughout the ore body. So it's got some good fundamental basis here that demonstrates to us this thing's a mine. This is the production schedule that was done by previous management team. Again, 100,000 ounces a year for 10 years and then stockpile rehandling in the last 6 years. We think there's a way to re-optimise that to shoot for something bigger and better. Something pushing closer to 130,000 ounces a year plus is sort of the target for us for a good initial 8 or so years, and that is certainly an initial target, but oxide dominant. You cannot find an asset that is oxide dominant doing 130,000 ounces a year for 8+ years. That doesn't exist in the market, and so that's why we think we've got a differentiated project. This is more about the DFS work that we're doing, so we'll have some commentary about this in the next couple of weeks, and then we're going to go and update the DFS and rebadge this as something bigger and more attractive and distinguishable in the market. I think the previous study had an element of hard rock costs in there that we're trying to remove, and that's why we think we can get the all-in sustaining costs lower than the 970 or so that it had at the DFS 2 years ago. We think we can bring that down. That's US dollars. Again, not all grade is equal, and just to lay it out pictorially here, so margin over grade is what we're focused on, and that's what's going to demonstrate a really strong economic project. It's no drill and blast, wear and tear, softer ore, low consumables consumption, reduced power consumption. That's all the benefits of soft ore, and as I show you on the next slide here, that bond ball work index of basically less than 1, you can't get much softer than that. And so that's DFS level test work. That's why we've got an element of confidence in here. And that's the typical flow sheet from mine to mill, and that's ours. And that's why we think we can do this capital efficient and operating cost efficient. So the benefits are there pretty clearly. I'm not sure how much time we've got left, but just on exploration. So all those resources are in the dark red there, but we control all these other structures on the ground. And where you see these numbers placed outside of that pit, we've also hit mineralisation there as well in this recent program. So that was 5 Ks of strike on that pit. We've now extended it to 11 Ks. So this is elephant country here. This is a camp district. And the best results of the program were less than 1 kilometre away from the pit. Never had drilling there before, called Kabata West, that top left there. 200 metre sections, we hit it for 600 metres. We had artisanal miners there, but no drilling, and we just drop some holes and we find some more mineralisation, and that's all throughout all throughout our land package there. So we're really encouraged that we can keep growing this resource over time. And so last couple of slides here, we've got a really clearly defined 2-year strategy here. So I recognise that our market cap is cheap, and so we're not running to put this into production tomorrow. So if you buy the stock today, committing to you that for 18 months, 2 years, there's no wave of dilution coming. And because there's 110 million bucks already sunk here, capital structure is going to stay tight. I don't have to do any significant drill outs. The resource is there. So I'm not raising 20 million bucks, 10 million bucks. It's keeping it tight. It's de-risking the asset and taking it to a production decision. So if you buy the stock today, you enjoy the re-rate. And if you don't want to be there when we transition from developer to producer, you take your winnings and move on to the next name. But right now, today, we're just going to focus on de-risking the asset and re-rating the story. And I think we've got the hallmarks there, as I've been outlaying, to do that. This is pretty clear. I guess it speaks for itself. When I say that we're the cheapest stock going around, you see us with a bunch of other peers, but I would just argue that an oxide-dominant stock that is free milling in all ore types, is permitted, is scale, should trade up the curve. And I've been arguing that, and no one's telling me I'm wrong. So it's a sign of the market that we're in today. But hard assets have a home in the gold sector. And for us, if we continue to do the work, which we have been, and delivering on what we say, that's going to keep going up the curve. So limited downside, a heck of a lot of upside here in Toubani. And I'll just leave it here. This is my last slide. The value proposition is really clear. We're $3 an ounce, peers are 17, and then the M&A in the last couple of years in West Africa. Chessa, the most recent example, just got taken out. 100% premium on a 50 mil market cap. That was worth $70 an ounce US. So the proposition's really clear. I'll leave it there, and thanks very much for your time.